First of all, I would like to thank you for your wholehearted support in Kotak Business Cycle Fund. We collected 78,000 applications from more than 5,700 partners with collection of 2,300 crore. Yesterday, we opened our fund for subscription and happy to state that NAV is above 10 rupee. If we look at US economy, US inflation is so high that US couples who are planning their wedding, they are today requesting guests to contribute for mortgage down payments. That's the kind of inflation US economy is facing. As this inflation has been running high, Fed has been raising interest rates at an unprecedented level. In the past, for doing 300 basis point rate hike, they were taking 18 to 36 months. This time, they have done that in just about 8 months. As Fed kept on raising interest rates unrelentlessly, market also discounted, and they have moved yields at the fastest pace since 1990. This unprecedented hike in interest rate has resulted into the largest drawdown in bond indices. US bonds are down about 16% in this year. As US interest rates went up, US dollar appreciated against all currency, and today it is at one of the most expensive level in terms of valuation vis-a-vis the rest of the world. As they say, when US catches cold, the world starts sneezing. And we have seen in the past that whenever dollar is strengthening, the world gets into trouble. Will this year be different? Will this time be different where surging dollar, expensive dollar does not put world into some kind of trouble? While US interest rates have gone up at a fast pace, the money supply has not reduced at that much pace. For inflation to cool down, not only interest rates should go up, but also money supply should come down. The money supply has come down less because Fed has been conducive in tightening liquidity. You could see in the month of June, against $47.5 billion liquidity tightening, they actually did only $3.6 billion. The same trend continued in July. Now, in the month of September, they were supposed to reduce balance sheet by $95 billion. We'll have to wait for the data to see whether Fed is walking the talk. It is possible that with falling commodity prices and liquidity tightening, inflation can drop sharply. Fed, while it's raising interest rates throughout calendar year 22 and first quarter of 23, will be cognizant that US debt to GDP has doubled from 1980s level. As we speak, US debt has crossed $31 trillion or $31,000 billion. US debt is now 10 times bigger than India's GDP. 1% interest rate hike means US will have to pay $300 billion extra in servicing cost. We believe that is a pain or a burden which US will not like to carry for long. US Fed also will be worried that while their March 22 and June 22 quarterly GDP growth was negative, and it will turn positive in rest of 2022. But there is possibility that higher interest rate and liquidity tightening could repeat negative GDP growth in second half of 2023. Higher debt burden, potential of recession in 2023, all will restrict Fed's ability to keep interest rate higher for longer. Even on the job opening side, last few data have shown remarkable drop in job openings. While still overall number of job openings exceed number of workers available, 1 in 6 American now doesn't want to work. If those people start coming back into workforce, then this ratio will start dropping, and it will probably help Fed engineer a shallow recession, which will enable them to again pump liquidity and cut interest rates somewhere in 2024. Today, we are seeing a very unusual scenario where United Nations has called Fed and other central bankers to halt interest rate increases, whereas professional institution like Bureau of International Settlement has said that continue to raise interest rates despite fear of recession. Clearly, two organizations like BIS and UN are exactly on the opposite side in terms of what should be the future of monetary policy. Globally, central bankers continues to follow Fed, and interest rate hike continues relentlessly. This interest rate hike is hitting disposable income and also sparking fear of global recession. EU is undoubtedly likely to be in recession in this winter. US, unless Fed does a U-turn, could head to recession in 2023 second half. Rising interest rates are also turning central banks into zombies. Reserve Bank of Australia is just like PMC Bank with negative net worth. The bond losses suffered by central bankers around the globe is very, very high. Swiss National Bank probably became the first central bank to report $100 billion of loss. This is also creating unique situation which can be described by famous Hindi song, Jaate hai Japan, Jaate the Japan, Pahunch gaye Cheen. Bank of England was supposed to buy out $800 billion of gilt holding. Bank of England was supposed to liquidate $800 billion of their own gilt holding and take away liquidity. Instead of that, as interest rate rose and long-dated gilt prices fell, they ended up buying 65 billion of gilt. They were supposed to make this 800 zero. Instead, they have made this 865 as they turned buyers into the market rather than sellers. This is reflected into GBP. One doesn't really know whether quantitative tightening is there or quantitative easing is there. Central banks are walking left, talking right. Jaate the Cheen, pahunch gaye Japan kind of situation. And that's creating confusion around the globe. If history is going to repeat, it shows that once inflation crosses 5% in advanced economy, as is the case today, it takes about a decade for them to come down to 2%. That means inflation is sticky and it's not going to come down in a hurry. If that's the scenario, then Fed's hand will be tied and the world will go into bigger recession. Another worry is that commodity producers, steel companies, metal companies, mining companies, telecom companies, they are not investing as much for creating supply as in the past. Now, if commodity producers are not going to create capex, are not going to spend money to create supply, how will inflation come down? While there are some players in the market who are worried about 2008 kind of crisis, where Lehman Brothers and Bear Stearns went into insolvency, and today there are doubts about a German and a Swiss bank, we believe probability of that happening is very, very less. In 2008, Lehman Brothers was dependent upon short-term refinancing. Now, thanks to the subprime crisis, regulators have tightened asset liability matching, and both Swiss and German institutions will have far less reliance on short-term refinancing. India is an oasis in the desert, but please remember, now we are in the midst of a sandstorm. The sun visibility will be less and sand will be flying all around us. Why do we say we are oasis in the desert? Last month also we showed this chart whereby we showed that India was the only country in the world which actually improved its debt to GDP ratio. Everyone else increased their debt to GDP ratio. We were the only country which actually reduced its debt to GDP ratio. That being the case, clearly we are oasis in the desert. If we look at the news headline, by and large, it's been very positive with drop in unemployment, increase in power consumption, increase in e-com sales, and PMIs, while coming down, are still in expansionary zone. Economic activity is nearly all-time high level. Broadly across power, freight, GST collection, exports, e-way bills, we are seeing broad-based recovery. PMI globally is falling. In India's case, it is broadly remaining moderated. GST collection consistently is remaining above 1,40,000 crore for almost 7 months in a row. One cause of concern is that the daily GST collected per e-way bill is more or less remaining constant, and GST collection is moving in tandem with e-way bill generation. And as you can see now, for last 2-3 months, e-way bill generation is moderating. That means the buoyancy in GST will not sustain unless activity picks up further. Thanks to robust GST collection as well as income tax collection is growing at a faster pace than budgeted estimate. Capital expenditure as a percentage of GDP is almost reaching all-time high level. RBI's survey of current consumer confidence index slowly but steadily seems to be recovering. There are mixed signals on retail consumption. on the malls and Main Street, retail sales seems to be recovering in the second half of 2022. Credit card sales have bounced in the month of July and August 22, and one can see that the run rate of credit card spending is almost increasing at 50% plus. The online e-com sales of festive season looks reasonably good based on initial estimates. However, in the month of September, FMCG sales dipped as inventories had choked dealer level pipeline. Bank credit growth is now in double digit, and people are expecting by the time we reach year end, it should be in 20% plus level. More importantly, banks' balance sheet have improved significantly from NPA point of view. Corporate balance sheet has also deleveraged. As I showed in previous slide, India is the only country which has improved its debt to GDP ratio and an overall basis, and also at household and corporate level basis. Again, this slide shows that Indian households are least leveraged compared to peers. Unemployment rate, which had gone up to as high as 25-30% during lockdown, is now coming around pre-COVID level. Monsoon has been on an average good across the country, except parts of northern India. This will result into lower rice production than last year, bringing down overall food production in this Kharif season compared to last year. However, reservoir levels are 25% higher than 10-year average, which means Rabi crop could be good and compensate for the drop in Kharif season. One red signal for Indian economy is appreciation of rupee against euro and yen, while we have depreciated against dollar, against yen and euro and GBP, we have appreciated. This makes their export to India more competitive and our export to euro and Japan less competitive. This can widen India's trade deficit and make India vulnerable. While crude prices did correct from $120 a barrel to $84 a barrel, the recent OPEC announcements that they will cut down oil production by 2 million barrels a day has pushed oil back towards $90. Obviously, every dollar increase in oil is negative for India. With lower oil prices but higher trade deficit, India's external situation continues to remain vulnerable. As of today, we can probably look at a sustainable trade deficit of $200 to $250 billion, and our run rate is actually $350 billion around. Clearly, we need to lower our trade deficit by almost $100 billion. How we do that will determine how good our economy will be going forward. One way to control trade deficit is to reduce imports from China. China is buying less from India and selling more to India. Our annualized import from China is now in excess of $100 billion, China is India's largest trade partner, and our trade deficit with China on an annualized basis is $87 billion. This is more than our defense spending. The amount of money we give to our military for spending, more than that we are giving to China for consuming China goods. When your trade deficit runs higher, you need capital flows. And in the past, higher trade deficit was kind of balanced by huge PE and VC flows coming into India. As global markets have gone into turmoil, PE and VC flows have also started coming down. And this has made managing trade deficit even more important. Clearly, in the India growth story, there is only one red flag, that is our external side, our trade deficit, which is about $100 billion more than what we can afford. Converting this into equity markets, well, India continues to remain one of the better performing markets around the globe. We have delivered far better return than our peers over last 2 decades. In last 8 years, we have delivered 8 times more return than our peer group. In 12 years, we have delivered 3 times more return than our peer group. In 20 years, we have delivered 50% more return than our peer group. Undoubtedly, FPIs have profit in India. This has happened thanks to MSCI India outperforming MSCI emerging market by a big margin since COVID correction. This is the IRR of foreign portfolio investors calculated by my colleague Harish Krishnan. From about 4% IRR on portfolio in COVID bottom, now it is in double digit. There are very few countries in the world where FPIs have enjoyed this kind of profit. Consequently, our weightage in MSCI emerging market index has increased from 7% to 14.1%. This massive jump in MSCI index ensures that we get higher allocation from passive flows. India continues to trade at a premium to other emerging markets. Historically, we have traded at 40% premium. Today, we are trading double that at 86% premium. On a one-year basis, India is looking expensive vis-a-vis peer group. But as another fund manager put it to me, on a 5-year basis, India is the cheapest emerging market. Domestic investors have played a fantastic role in protecting the downside of market. Between October 21 to June 22, foreigners sold 2,55,000 crore. More than 1,91,000 crore was bought by mutual funds thanks to support of all of you. And that ensured that market didn't crash, but corrected by mere 17%. In the period where FPIs became buyer along with mutual funds, they have pumped in just about 57,000 crore. Mutual funds pumped in about 10,000 crore, and market's correction has come down to just about 7% despite massive sandstorm blowing out. One good news about October, well, October is known as the bear market killer. In 6 of the past 17 years, since World War II ended in October, October has created positive return for investors globally. In India, the record is even better. October has traditionally been the best month for Nifty in last decade or so. Will this October be different? Who knows? There is reasonably good chance that MSCI Emerging Market India, there is a reasonably good chance that India's weight in MSCI Emerging Market Index can increase. This can happen if MSCI upgrades Korea like FTSE index and its weight gets distributed to rest of the emerging markets, including India. Or HDFC Bank becomes part of MSCI India post-merger of HDFC in March 23. In this two scenario, India's weight in MSCI can go from 14% to almost 17%. This will mean more flows coming to India. What will foreigners do? Will they follow Sean Darby's advice? Who said candidly, I think a lot of foreigners sold out of India perhaps too early. That in retrospect looks like a mistake. India is a compounding story for decades. Why sell in 2021 or 22? If we look at a country like Japan, in the 70s and 80s, long before the 90s bubble, Japanese economy was doing well vis-a-vis US. And in that scenario, while Dow Jones remained almost flat between 70s to 80s, Nikkei continued to rise and it delivered massive outperformance in the decades of 70s and 80s. This is well before it reached bubble in the 90s. So it is possible for a growing economy to deliver better return even in a phase where Dow Jones is almost stagnant. Valuation-wise, Indian markets continue to factor in all the positives. We are one of that rare country whose P ratio hasn't corrected compared to the rest of the world. We are here right at the top of our historical range, whereas everyone else is at reasonably bottom end of their historical valuation range. Our market valuation continues to remain superior vis-a-vis other market. We look expensive vis-a-vis India, vis-a-vis rest of Asia. On a historical basis, our valuation is near our historical average. So our valuations have remained constant, but rest of the world's valuation has come down. Earnings estimate have started coming down little bit to factor in higher energy prices. However, the revisions are fairly subtle. The revision has been led mainly by sectors which are linked globally, like metals, like autos, like energy. In the IT sector, relentless bloodbath continues. First, there was worry of slowdown and recession on sales growth. Then there was worries about availability of manpower and margin pressure as you had to pay higher salaries. If those two things were not enough, the troubles have come in battalion. And now there are worries about financial institutions, which are the biggest consumer of Indian IT. In 2008, when Lehman Brothers collapsed, IT sector made a bottom at about 8 times P. Today, IT sector is trading at a much higher level. This Lehman Brothers movement is keeping IT sector under pressure, and which is why we have remained underweight IT across our portfolios. We have been overweight banks, and we believe banks will continue to do well going forward. This is the first quarter where public and private banks put together will be reporting almost 50,000 crore of profit. This is the first quarter where they will be touching near that number. Next slide, please. We also believe auto, industrials, cement, and consumer discretionary will do well over next 12-18 months. Auto sector's profit in top 1,000 profitable companies have ranged from 0.9% to 10.5% in the past. Today, it is at 2.5%. We believe this ratio is likely to go towards 10.5%, and hence one should be overweight auto. The same thing in industrials. Profit cycle is going to go from 5% towards 9%. Same thing in cement, and same thing in consumer discretionary. These are the sectors where we are overweight, as we believe profitability will be superior to market. Our call continues to remain the same. This is a market where you have to be ready for volatility. We are recommending equal weight allocation to equity, and within that, marginal overweight to large cap and marginal underweight to small and mid cap. This is the market where every correction is an opportunity to increase your allocation to equity. Keeping in mind massive global sandstorm blowing, and despite our oasis situation, be ready for volatility. We are right now in the middle of a roller coaster ride. Some days roller coaster will go down, someday it will go up. From an equity market point of view, Kotak funds continue to generate alpha across majority of its equity funds, as well as across its hybrid funds. Our SIPs continue to deliver outperformance over benchmark index across majority of our funds. The same is true in relation to hybrid funds. One of our flagship fund, Kotak Flexi Cap, had met with rough weather. Some of our investment calls had gone not as per our expectations, but now our calls are coming right, and the fund is back to its original position of outperforming benchmark indices, as well as coming in top half of peer group. We have observed that a lot of money has gone into Flexi Cap fund with local plus global exposure. In our forte, we have a fund called Kotak Pioneer Fund. It's not as well known among investors despite its stupendous performance since inception, where it has delivered about 22% return over last 3 years. Currently, 18% of the portfolio is in global stocks, mainly into technology side, and 82% investment on a flexi cap basis is towards pioneering companies, innovative companies. We believe this fund deserves attention. It must become part of your investor's portfolio. It has delivered as good performance as market leader in this category of global plus local fund. We had launched a fund called Kotak Manufacture in India beginning of this year, that fund has done extremely well with about 11% plus return. More importantly, it has generated 7% positive alpha. We continue to believe in manufacturing renaissance, China plus one, government spending, PVC-led support, and private sector capex beginning. Put together, manufacturing sectors in India will continue to do well over next couple of years. We had launched last year another fund called Kotak Multi-Cap that also, despite its volatility, has delivered positive return and also positive alpha. One blot on our track record is Kotak Global Innovation Fund of Fund. We wanted to provide geographical and business diversification to investors. Unfortunately, timing-wise, this fund's performance has been marred by China tech sell-off, by US Fed rate hike, by global tech meltdown, and inability to average at current prices. Despite its poor track record since launch, we'll recommend investors to stay invested in this fund, as if you redeem, you won't be able to put it back, as RBI has kept amount which can be taken outside. One fund which we are very proud of is our tortoise cum hare fund. This go up faster when markets are rising, and they fall slowly when markets are falling. Kotak Equity Savings Fund has equity allocation of 10 to 50% depending upon market situation. Currently, it has 29% allocation to equity. Currently, it has 34% allocation to equity, but historical equity allocation is around 29%. With 29% equity allocation, it gives 39% upside when markets are rising and only 11% downside when markets are falling. This has created an enviable upside-downside ratio of 4. This fund on the way up, outperformance on the way down by almost 4 times. Same thing happens with our multi-asset allocator fund, where with 46% average equity allocation, we give 65% upside and only 29% downside. This again creates an upside-downside ratio of 2% of 2 times. And currently in multi-asset allocator fund of fund, 69% is equity allocation. In cryptos, bloodbath continues. NFT volumes are down about 97% from peak, despite some circular trading. Silver, while we don't have fund yet, we are in the process of launching. And this was an interesting slide we picked up while doing our research on silver market. Last time silver went up 10% was in November 2008 during subprime crisis. And thereafter, it went up about 400% in next 2.5 years. Could silver be giving similar signal at this point of time? Coming to the fixed income market, Fed continues to be aggressive, and now market is pricing in about 4.6% Fed rate in 2023 and rate cuts in 2024, 25, and 26. US yields have moved across the curve much more at the longer end than at the shorter end. The difference between India and US 10-year GSEC yield is at a 30-year low, We had achieved that only during 2008 subprime crisis period. Will this gap narrow or will this gap increase? Indian inflation has consistently remained below American inflation for almost last whole year. This has never ever happened in our history before. In terms of positioning of India vis-a-vis peer group, we are in a far better shape to tame inflation and manage interest rate cycle. Inflation, while continues to remain above RBI's comfort zone for the time being, Jan-March 23, we should see Jan-March 23, we should see inflation coming below 6%, and inflation expectation for next year, first quarter, is below 5%. The banking liquidity has come down dramatically as RBI intervened in rupee market, and that has resulted into 10-year yield climbing a little bit along with Fed rate hike. At this point of time, we believe the short to medium end of the curve between 3 to 5 year gives good carry as well as downside protection in case interest rates have to go further higher from current level. There were rumors that India will be part of JP Morgan bond indices at the instance of investors. However, JP Morgan announced last week that India will not be considered for inclusion this time. This has pushed 10-year yield by about 10 to 12 basis points towards 7.5%. Fed rate, as it continues to go higher, the emerging markets have continued to contract or correct. As I mentioned earlier, India vis-a-vis US in terms of real rates is fairly better position, and which is where rupee has been one of the best performing currency across the globe. We believe time has come for rupee to depreciate a little more from current level of about 82 to a dollar. In debt market, please match your investment horizon and funds maturity or duration so that there is lesser impact of interest rate volatility. In the medium term, one can look to invest across, previous slide please. In the medium term, one can look to invest across corporate bond fund, floating rate fund, short-term bond fund, or banking and PSU debt fund. In all these funds, carry looks fairly comfortable. There are many people who want to invest in roll down strategy. That way they can be reasonably sure about what kind of return is going to come over the investment horizon. Our recommendation will be to go towards dynamic bond fund. This kind of funds have outperformed roll down strategy by a reasonably good amount. The same has happened with dynamic bond fund, continuing to outperform its benchmark indices and delivering better return to investors. Our hybrid funds like Kotak Debt Hybrid Fund, Kotak Equity Savings, or Kotak Equity Hybrid have all delivered almost double-digit return over 3, 5, 7 and since inception basis. 1-year return undoubtedly has come down as markets have corrected, but still they are comparable vis-a-vis conservative funds like fixed income funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.